Wall Street dips amid mixed earnings, and crude price drop ahead of trade deadline. As we navigate the complexities of financial markets, one can't help but feel a sense of uncertainty that grips investors these days. Currently, Wall Street is experiencing quite a rollercoaster ride, showing volatility as mixed corporate earnings come to light, while crude oil prices continue to slide, all against the backdrop of an imminent trade deadline. On July 22, 2023, in New York, traders observed a dip in Wall Street's major indices. Investors were caught in a swirl of contrasting earnings reports, indicating that President Donald Trump's extended trade conflict is starting to impact corporate profits significantly. This comes just as the pressure mounts, with talks between the United States and its trading partners showing little progress ahead of a critical deadline. The S&P 500 index was slightly down, and the technology sector took a hit, dragging the Nasdaq index down even further. In contrast, the Dow Jones Industrial Average managed to cling to slight gains. Interestingly, gold prices rose as the dollar weakened, which is often seen as a safe haven for investors during turbulent markets. Treasury yields also declined for the third consecutive day, hinting at cautious sentiment from traders. Investors are looking for signs of stability and positive momentum, but they are receiving mixed signals from the earnings reports, reflecting the ongoing uncertainty regarding tariffs and the overall market direction, explained Robert Pavlik, a seasoned portfolio manager at Dakota Wealth in Connecticut. He pointed out that companies are expressing caution during this time of unpredictability. As we delve deeper into the earnings season, approximately one-fifth of the S&P 500 companies have reported their second quarter results, and an impressive 79% of them have exceeded analysts' expectations, according to data from LSEG. Despite this positive news, analysts project a 7% year-over-year growth for S&P 500 earnings. While this figure shows an improvement from previous predictions, the impact of the ongoing trade war is increasingly filtering into businesses' financial performances. For instance, General Motors reported a staggering 32% drop in core profit due to hefty tariff costs, amounting to a significant $1.1 billion reduction in its earnings. The possibility of reaching a trade agreement between the US and the European Union seems to be dwindling as the August 1 deadline approaches. This has prompted EU nations to consider potential retaliatory measures against perceived coercion from Washington. U.S. Treasury Secretary Scott Bessent mentioned that he is slated to meet with his Chinese counterpart to discuss the potential for extending the deadline for trade negotiations. This reflects the complexities surrounding technology exchanges and rare earth materials between the world's two largest economies. Pavlik remarked, "Trump appears eager to finalize trade agreements, but other nations seem reluctant to be coerced into arrangements, thus pushing back against U.S. demands. This entire scenario seems artificially manufactured. The president could have approached this situation more tactfully to achieve smoother outcomes, rather than bulldozing through negotiations." In terms of market performance, the Dow Jones Industrial Average closed up by 38.96 points, or 0.09% at 44,362.03, while the S&P 500 fell by 6.29 points, or 0.1%, settling at 6,299.49. The technology-heavy Nasdaq Composite slid by 89.48 points, representing a 0.43% decrease, landing at 20,883.37. Globally, the MSCI index measuring stocks across various markets dipped by 0.08%, and European markets reflected similar trends, with the Pan-European Stocks 600 index dropping by 0.47%. Emerging markets did not fare well either, with stocks in this segment declining. Asia-Pacific shares outside of Japan followed suit, as did Japan's Nike, which edged down slightly. Continuing this trend, the dollar weakened in the currency market as investors cautiously awaited progress in the ongoing trade dialogues ahead of the August 1 deadline. The dollar index, which compares the American currency against other major currencies, fell by 0.28%. Interestingly, cryptocurrencies experienced a bit of a stir, with Bitcoin rising by 1.82%, while Ethereum saw a slight drop. As U.S. Treasury yields were set to decline for a third day, the market seems to be holding its breath, gauging the effectiveness of the previous day's rally. Various coupon rates for U.S. Treasuries showcase declines, reflecting a cautious market. In commodity markets, U.S. crude oil prices fell by 1.56%, reaching $66.15 per barrel. Brent crude likewise experienced a fall, down 1.37% at $68.26 per barrel. Spot gold saw a modest increase, gaining 0.9% to $3,425.89 an ounce, while U.S. gold futures also reflected growth. With all these developments, it is clear that we are standing at a pivotal moment in economic history. Will the trade negotiations yield a fruitful resolution, or will uncertainty continue to loom over the markets? Share your thoughts below. Do you agree with the analysis, or do you see things differently? Wall Street update: GM earnings hit by tariffs, RTX profit cut, and market mixed reactions. In the ever-fluctuating world of Wall Street, investors are grappling with a mix of optimism and concern as key players navigate both market pressures and global trade tensions. But here's where it gets controversial. While some companies are riding high on the wave of artificial intelligence investments, others are crashing under the weight of escalating tariffs. The question everyone's asking is whether these trade policies are a necessary correction or an overreach that could hurt the economy in the long run. On Tuesday, July 22, Wall Street experienced a day of mixed results, with General Motors, GM, taking a significant hit, a nearly 7% plunge, after revealing that tariffs had cost the company a staggering $1 billion in quarterly earnings. This revelation has reignited concerns about the impact of U.S. President Donald Trump's aggressive trade policies. Notably, Ford Motor also felt the pinch, shedding almost 1% of its value. For those unfamiliar with the intricacies of trade tariffs, these taxes on imported goods can disrupt supply chains, raise production costs, and ultimately eat into corporate profits. But GM wasn't alone in its struggles. RTX, a major player in the aerospace and defense sectors, saw its shares drop by 1.3% after slashing its 2025 profit forecast due to rising tariff-related expenses. Despite robust demand for its engines and aftermarket services, the company couldn't escape the financial drag caused by ongoing trade disputes. Meanwhile, Lockheed Martin faced an even steeper decline, with its stock plummeting 8% following an 80% nosedive in quarterly profits. A stark reminder of how quickly market sentiment can shift when earnings reports disappoint. Amid this turbulence, the broader indices reflected the uncertainty gripping investors. The S&P 500 eked out a marginal gain of 0.01%, closing at 6,306.28 points. Conversely, the tech-heavy Nasdaq Composite fell by 0.36% to 20,898.66 points, while the Dow Jones Industrial Average managed a modest uptick of 0.23%, settling at 44,425.88 points. Interestingly, 9 out of the 11 S&P 500 sector indexes ended the day in positive territory, led by healthcare stocks, which surged 1.46%, followed closely by real estate, up 1.29%. These gains highlight the resilience of certain industries amidst broader volatility. However, not all sectors were spared from setbacks. Philip Morris, for instance, saw its shares tumble 7.3% after reporting disappointing second-quarter revenue figures. The culprit? Sluggish sales of its ZY and nicotine pouches, which failed to meet sky-high expectations set by analysts. Such examples underscore how shifting consumer preferences and competitive markets can catch even established brands off guard. And this is the part most people miss. Beyond individual company performances, macroeconomic factors continue to loom large over investor decisions. With Trump's self-imposed August 1st deadline for several countries to negotiate agreements with the White House fast approaching, uncertainty around U.S. trade policy remains a dominant theme. U.S. Treasury Secretary Scott Bessent announced plans to meet with his Chinese counterpart next week to discuss extending the August 12th tariff deadline on imports from China. Yet, progress appears elusive elsewhere. Talks with India seem stalled, and EU officials are reportedly considering retaliatory measures against American tariffs. For beginners trying to make sense of these developments, it's essential to understand that trade negotiations have far-reaching implications. They don't just affect the companies directly involved, but ripple through entire economies, influencing everything from manufacturing jobs to consumer prices. Moreover, the looming possibility of interest rate adjustments adds another layer of complexity. After last week's patchwork of economic data, traders have largely ruled out a rate cut by the Federal Reserve at its upcoming policy meeting. However, there's still speculation about potential reductions later in September, according to tools like the CME's FedWatch. As we look ahead, the coming weeks promise to be pivotal for Wall Street. From the so-called Magnificent Seven tech giants releasing their earnings to critical trade deadlines, the stakes couldn't be higher. So, what do you think? Are tariffs a necessary evil to protect domestic industries, or do they risk stifling global growth? Share your thoughts in the comments below. We'd love to hear your perspective.